Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Chief Investment Officer EMEA and Global Head of Equities. And we're going to discuss some of the key themes driving markets. These include the pullback in equity markets, the political scene in Europe, and our response to market movements. So Mark, markets appear to be pausing for breath following a strong run since the Trump election victory. Why do we think that is?
Well, markets certainly got pretty optimistic pretty quickly about the global growth outlook following Donald Trump's election, and some of the measures that he suggested might be put in place with regards to fiscal spending, tax cuts and so on and so forth got people excited about the global growth outlook and the consequent implications for corporate profits and earnings. And I think that we're just reflecting as to whether that still holds true, particularly in light of the interest rate rise we've seen from the Federal Reserve, but also his inability to push back on Obamacare has made some market participants wonder whether that's also going to have consequences for his ability to get fiscal spending measures in through and also tax changes through. So just his ability to execute his policies is making market participants wonder about the growth outlook, having got, as I said, quite excited and quite optimistic quite quickly.
And similarly, we've seen bond yields pull back. Have we become less optimistic on the growth outlook?
Well, again, reflecting on Trump's ability to execute his plans, that's one thing. Secondly, whilst many of the leading indicators are showing very robust optimism for the future, some of the on-the-ground data in the here and now is suggesting that growth, particularly in North America, is not as robust as the leading indicators would have us think. So that's led to a downplay of expectations for growth more broadly, and consequently we've seen bond yields come off the highs of the near term and settle back down at lower levels, reflecting just maybe less optimistic outlook about the growth.
Politics in Europe is set to be an important theme for markets this year. What have we learned from the Dutch election, and how important is the looming French presidential election?
It's very important. Clearly, we've seen with Trump and before that Brexit that politics can have an enormous impact, not on just the geopolitical backdrop, but also on the global economy and the implications for markets. And the French election is very important. There are concerns, clearly, about whether if Le Pen and Front National win, whether they will follow through on their desire to take France out of the EU, and certainly that is a manifesto pledge, certainly to hold a referendum similar to the UK. If they were to do that, that would have profound implications for the Eurozone, for the financial system and for the robustness of the banking sector specifically. Now, we've had a bit of a foretaste of that in the Dutch election, where we also had on the face of it, pretty popular far-right candidate, and in the end, that candidate did less well in the elections than had been feared, and so we've seen peripheral spreads and French bonds in particular kind of ease off a bit in response to that, reflecting the less likely outcome potentially of a Le Pen victory, but it's certainly all to play for and it's critically important.
And in terms of the equity market, how are sectors performing, and what is this telling us about the corporate earnings season?
Corporate earnings have been pretty good actually, particularly in Europe rather surprisingly, and many people forget the fact that last year European growth was 1.7% and US growth was 1.6%, i.e. European growth was stronger than it was in the US. As we became more optimistic about the outlook for global growth, the cyclical sectors, the recovery sectors, the industrials, the energy sector, mining and so on and so forth performed very well. They've started to pull back a bit in response to the fact that growth may not be quite so robust. So we've seen a bit of a reversal, albeit very much in the short term, but we've seen a bit of a reversal in terms of how sectors have been performing, reflecting a different take on what growth might be.
And with all of that in mind, have we changed our stance on markets, and which equity markets do we favour and not favour currently?
Well, we still favour Japan. We think that Japan looks cheap. There's corporate government reforms coming through, and with a stronger dollar and a weaker yen, that's good for Japanese exporters. We've also, perhaps surprisingly to some people, recently increased our exposure to the European stock market. There is a lot of political risk discounted. The valuations are lower, it's quite out of favour, and earnings momentum is pretty positive in Europe. The PMIs, the leading indicators, are suggesting that growth is going to be quite robust, and so we've made a relatively counter-cyclical increase in our exposure to European equities. Conversely, we've recently taken money out of the US stock market. The US stock market's performed very well on expectations for US growth picking up. Valuations there are much higher than they are elsewhere in the world, and it appears to us to be most people's favoured market, so we're trying to be a bit against the trend there. So we've recently reduced our exposure to US equities.
Mark, thanks very much.